All right, welcome to Talk Tickers. We're diving right into Synchronoss Technologies, that's ticker SNCR, and their Q3 2025 earnings. And let me tell you, this report is a real head scratcher. You've got some good, you've got some bad, it's a very mixed bag. So let's get into it.
Okay, here's how we're going to break it down. First, we'll hit the raw numbers. Then we'll get into what management is saying. After that, we'll look at the big picture for investors, and then I'll give you my take, the next call, before we wrap with the key takeaways. Simple as that.
All right, let's jump into section 1, the results. And yeah, the subtitle says it all, a quarter of conflicting signals. It's like the market didn't know whether to cheer or run for the hills. So first up, the good news, a massive beat on earnings per share. I mean, look at that, plus 36 cents. The street was looking for 15 cents and they delivered 51. That's not just a beat, that's an absolute blowout on the bottom line. But, and this is a big but, the top line? Not so good. A revenue miss of almost 3%. And there you have it, folks. That's the core problem. The big contradiction of this quarter. Fantastic profits, but sales are heading in the wrong direction. Let's put some hard numbers on that. You can see it plain as day here. GAAP EPS, 51 cents versus a 15-cent estimate. Amazing. Adjusted EBITDA at 12 million. That's solid. And hey, almost 94% of their revenue is recurring, which is what you love to see for stability. But then you get to that revenue line, 42 million, when everyone was hoping for over 43. That's the number that's causing all the heartburn. So how did the market react? Well, it was pure chaos, really. At first, you saw a pop in after-hours trading. The algos and early traders saw that huge EPS beat and bought in. But then, people actually read the report. They saw the revenue miss, they heard the guidance cut, we'll get to that in a second, and boom, the stock completely reversed and ended up dropping nearly 3% the next day. A classic case of read the fine print. Okay, on to our next section. Let's go deeper and unpack what management is actually telling us. What's their story? And it all starts with this quote from the CEO, Jeff Miller. He's basically saying, hey, yeah, we know revenue was a little light, but look over here. Look at how profitable we are. This is a classic pivot. They're trying to shift the focus from growth, which is weak, to financial health, which is improving. This slide really nails it. Think of it as a coin. On one side, the shiny side, you've got all the wins. I mean, an EBITDA margin of 28.5%, that's great. Strong free cash flow, cutting costs, fixing the balance sheet, all good stuff. But flip that coin over, and you see the challenges. Revenue is actually shrinking year over year. Subscriber growth has just stalled. New deals are getting pushed back. It's a tale of two companies right now. Now, to their credit, they've been very smart about shoring up the balance sheet. This is a huge part of the bull case. They refinanced their debt, got a nice big tax refund, and what did they do? They didn't go on a spending spree. Nope. They used it to pay down their loan. That brought their leverage way down to a much healthier level, around 2.7 times EBITDA. That's a solid move. Okay, but here's the other shoe dropping. This is the slide that really scared the market. They cut their full year guidance, not just on one thing, but on everything. Revenue, down. EBITDA, down. Free cash flow, down. And the excuse? It's the same story. Weak subscriber numbers and deals taking longer to close. That's not what investors wanted to hear. So that leads us right into our next section, the investor context. Let's pull back the lens a bit and figure out why Wall Street is so darn skeptical. Wow. I mean, this chart just says everything you need to know. The overall tech market, the QQQ, is up almost 20% in the last year. The software industry is up over 11%, and Synchronoss down over 44%. This isn't just a recent slump. This is a story of chronic, painful underperformance. The market has completely lost faith. And that skepticism didn't just appear overnight. If you look at the timeline of the past few months, you see a clear pattern emerging. Q2 earnings, same story. Revenue miss, guidance trim. Sure, they got that one-time bump from the tax refund news in July, but the core business, it's been a story of one step forward, two steps back, especially on the revenue front. And here's the crazy part. The wind should be at their back. The whole personal cloud market is growing. Carriers desperately need services like theirs to make more money from each customer, what they call ARPU. Synchronoss is sitting right in the sweet spot of this trend. So the fact that they still can't grow, well, that's what makes this whole situation so frustrating and, frankly, concerning for investors.
All right, let's get to it. Time for the next call. This is where we put it all together and figure out what to do with this stock.
So it all comes down to this, right? The stock's been absolutely crushed for a year. What happens next? Where does it go from here? You've got two very different camps on this one. The bulls are saying, look, the heavy lifting is done. The balance sheet is clean, the business is profitable, and big new customers are coming. But the bears are just shaking their heads, saying, we've heard this song and dance before. They can't execute, growth is dead in the water, and we don't believe a word management says. It's a classic standoff.
So where do we land? For us, the call is market perform. It's not a sell because the valuation is cheap, but it's definitely not a buy. There's just too much risk, too much of a prove it to me story here.
And we're putting a $10 price target on it. Why 10 bucks? Well, it gives them credit for fixing the balance sheet and for being profitable, but it also bakes in a healthy dose of skepticism about whether they can actually start growing again. They need to land those big deals they keep promising.
All right, let's bring it home. Here are the key things you absolutely need to remember.
Okay, takeaway number 1, remember that two-sided coin. Awesome profitability, terrible growth. Number 2, management gets an A for financial cleanup, but an incomplete for growth. They haven't proven they can do it. Number 3, that minus 44% stock chart tells you the market has zero trust right now. And finally, everything, and I mean everything, hinges on them signing new big customers. They've bought themselves some breathing room with the balance sheet, but now they have to deliver. The clock is ticking.
And one last thing, you know the drill. This is just our analysis. It is absolutely not financial advice. Please do your own homework.